Okay, good morning and happy Tuesday. Welcome back to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Let's go ahead and get started because there's a lot to cover here today. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So, and just a quick bit of housekeeping here. What we are going to have is another members only session this Friday where we're going to be covering technical analysis. We've been doing a lot of back testing on technical analysis. We have a whole document to share with you as far as what we have found from different technical indicators and the performance specifically of each technical indicator. And there are some surprising observations as to which technical indicators had some pretty strong performance, which ones had some weak performance, which moving averages to use. So a lot of insights into a lot of the common questions that I have heard over the past 10 or 15 years with respect to technical analysis. We're going to try to help answer that. So this Friday, instead of doing our typical market outlook that we typically do, we're going to do that members only special for technical analysis. So please join us for that, for those of you that use technical analysis for your trading. So today what we're going to do is we're going to start off the broader market update. We're going to show you that the fact that equity markets are currently much more in a bullish tone, what that means, what warning signals we also see at the same time with these moves to the upsides, especially from volatility. We're going to take a look at commodities and rates as a proxy for how markets are in other markets are currently positioning for this current market. We'll take a look at the FANG stocks because, as we saw yesterday, a lot of the performance came from just a few stocks in the broader market. So it's important for us to understand where those major stocks stand to give us a better understanding as to the broader market outlook here. And lastly, we'll share with you our ideas here for the markets, given the fact that we're about to enter into this earnings season, what we see opportunities from that perspective in the immediate future, and then what tech names you might want to focus on, and maybe some more defensive plays as well, especially in this type of market condition. I think it makes sense to not have all of your eggs in one basket. So it's important to understand what are the different opportunities that we're currently seeing in the market. And at the very end, if we have a few minutes, I'll open this up for Q&A. But the primary question that I want to help investors answer predominantly that we have received over the past couple of days is really, can the markets continue to break out to new all-time highs? Because we are now within spitting distance of recent all-time highs. And the question is, can we break out and continue going higher here? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I will be sharing with you my charts and the technical research that I'm currently viewing to inform my broader market outlook that I currently have here for the markets. So let's take a look at the NASDAQ 100 index first, because this is one that we're looking at predominantly. And what we currently have here is a 282 and a 282.5 level that we've referred to for quite some time here on the QQQ. This was the high that the NASDAQ 100 index put in initially after the plunge on September 3rd or so. And 282 has managed to be a major resistance level. And since then, what we have had is what I would consider an inverted head and shoulders. So a consolidation and a potential reversal pattern of this decline here. And just on Friday, we broke out above the inverted neckline of that inverted head and shoulders, and markets have moved substantially higher very, very quickly off of that. And we are now, again, within spitting distance of that all-time high of 303. We're about to open up about 295. So pre-market has gotten a little weaker here over the past couple of past hour or so since I've been sitting here. We're down about 1.5 points here since I started sitting down here at my desk this morning. So what we have seen is that this move has been fairly quick and violent, almost a little bit of a melt up, if you will, that we currently have seen here in the market. So this is a little bit of a warning sign here that we're currently seeing, but we're going to pay attention to some of the other things to inform us. When we look at the S&P 500, we see a very similar picture. A lot of strength here from the S&P 500 over the past couple of days, but similar inverted head and shoulders formation managed to break back above it. What that means for me is that this is very likely going to test those all-time highs, and we are going to see how the markets respond to those all-time highs and whether or not it continues to move higher. Now, so far, everything points that this is likely going to happen, because what we've effectively have seen is our long periods of outperformance, brief periods of consolidation, usually about a month long, and then a long period of consolidation. A long period of moves to the upside, and then further gains to the upside. That's exactly the pattern that we have seen, and that's the pattern that we have continued to play out here in the broader markets. Now, the only thing is that these breakouts here so far have been very, very quick, meaning we've been reaching some of our target prices substantially sooner than we were originally anticipating. So the breakout here has been significantly faster. If you weren't in some of the big tech names here over the past couple of days, you may have missed out on this rally. And the question is whether this rally will continue, or this is perhaps a little too far too fast. And that's the answer, that's a question that we want to help answer here today. Now, when we take a look at the broader markets, when we look at small caps have seen a lot of strength here over the past couple of weeks. And generally speaking, small caps is the type of segment of the markets that you would see outperform during the recovery of a recession. And one could argue that we are in the recovery phase of a recession. That's why we've seen such a strong outperformance here of the IWM. And we've seen this move break out above this 160 level, which has been a major resistance level here for a long time here on the IWM. And we've now broken out above this level. We have seen confirmation on accumulation distribution of a breakout of that level. So we are certainly in a much healthier market rally here when you have small caps, large cap, S&P 500 all breaking out higher and confirming those moves higher. That is, generally speaking, a good sign for the breakout that we're currently seeing, and leads us to believe that this is a true breakout and can have some legs to continue testing those all-time highs and continuing to move higher. When you look at RSP, the equal weight indices, also seeing fair amount of strength here. Certainly losing a little bit of momentum here on the equal weight indices at this 114, 115 resistance level. So it's yet to see if we see a breakout here, but accumulation distribution did confirm that breakout, and momentum did confirm new highs. So we certainly still see that RSP, the equal weight indices, can continue to grind its way higher, and at the very least continue its move higher here while the major tech names drag the markets higher here. So it's a fairly healthy market that we're currently seeing. However, there are some unusual patterns that we have noticed here that signify, or that we have seen coincide with some market tops previously. And that is predominantly the fact that yesterday, when the NASDAQ 100 was up 3%, the volatility index that tracks the NASDAQ 100 index was also up. These two typically work inverse. They have an inverse relationship. When the index is up, volatility is down. But yesterday we saw volatility was up and the index was up. This doesn't happen very often. And when it does, we have seen this traditionally signify that we are near a market top. But I do want to point out here, what we have seen this before, even though we saw it before, the market still moved substantially higher after we saw that signal before the markets reverse lower. So just because you have the signal in itself does not mean that it's time to go short the markets. It's just a warning sign that markets are perhaps going a little too far too fast. And that's sort of what we see here. You know, when the NASDAQ is up 3%, but the Dow is up 0.6%, 0.8%, you know, that speaks to a market that isn't particularly healthy. That speaks to just a few tech names dragging this market higher. And that's certainly what we're starting to see. Some of that is the complacency that we saw near those September highs, where a substantial amount of call buying that wasn't coincided with a substantial amount of put buying. We're seeing put call ratios starting to trend back down. So meaning a substantial higher amount of call buying versus put buying. And as you can see, that ratio was 0.56 yesterday. So almost double the amount of call buying and put buying. And this is what drove some of that higher implied volatility, was investors trying to buy implied volatility, whether this is because of call buying before you know, Amazon Prime Day, the Apple event here today, both of which we'll talk about. But you know, this is what's driven some of the increase in call buying activity. And that is something that we could see is what drove the increase in volatility while the index itself moved higher. But when you have these types of extreme call buying, that also is more of a complacency indicator. And that, generally speaking, is contrarian. You generally don't want to chase these too much, or if you're chasing them, you want to chase them using limited risk strategies like call options. And you generally want to keep those call options for a relatively short amount of time, because these are signals that perhaps we are near a reversal point here. Now, these reversal points could just last a few days. It doesn't mean that we're looking at a larger structural reversal of the broader markets. But from a positioning perspective, we are short-term fairly overbought. When we see these complacency indicators, that leads us to believe that it's not a good time to enter fresh new longs in some of these tech names because there's a higher probability of that pullback here. So when we look at that and we couple that with some of the other indicators such as commodities and fixed income, this provides us also with another view of just, whether markets are in a risk on, risk off environment. Now, gold has been a major player in the, I would say, investors' portfolios here over the past couple of months. And what we have is gold continuously trying to hold the 180 level as support, but finally broke down below that a couple of weeks ago. But just over the past couple of days, managed to poke its way back above that 180 level. Now, I don't necessarily know that it's all clear here on gold, but depending on how you draw your charts, this is certainly starting to look like a bit of a turnaround here, a bit of a reversal here for gold to continue moving higher, or at least stem its downside move here to the downside. So for those of you that are either invested in gold or perhaps looking for an opportunity to get into gold, this is one that I would pay attention to, because your risk reward ratio here is fairly strong. You have a fair amount of upside all the way into the high 190s, and your downside here is just about 175, 174 or so to the downside. So risk reward ratio here on gold, from my perspective, looks fairly attractive. All the concerns that we had about inflation, about risk, about rates going to zero, from my perspective, none of that has gone away. So the thesis for long gold remains. And I think from a technical perspective, this provides you with an interesting opportunity. And from a risk and reward perspective, a more attractive entry point for those of you that also agree with that gold thesis. When we look at fixed income, we've seen a pretty big reversal here from fixed income. Just a few weeks ago, I noticed that the HYG high yield fixed income ETF broke below a major support level at 84. This was a fairly major line in the sand that if it broke below, what that told me was that investors were starting to see some risk in these, or no longer wanted to take on the risk of these more riskier fixed income products. And we're starting to see outflows and starting to see selling of these products into more safer products like TLT treasuries. But we've seen a stark reversal here over the past couple of weeks after that breakdown here. And it's actually testing those relative highs and potentially making a new high above that. If that happens, if we do get this breakout, that certainly is a big vote of confidence from my perspective that the fixed income markets are providing, that there's more inflows into these riskier products, and just not seeing the same type of flows into the treasury products. If you look at TLT has now declined to that 200-day moving average. It has held that 200-day moving average. So I also think that from a TLT perspective, that you could potentially look at selling some put options here on TLT to take advantage of the fact that rates, while remaining a little elevated, will likely continue to drift down going forward, and that is likely going to keep TLT supported here around that 200-day moving average and start to move a little bit higher off of that. So the type of option strategy that makes sense for that type of outlook is to either sell puts or put spreads, depending on which one of those two strategies you prefer for your portfolio. But both of them, in my opinion, are suitable because of the relatively, again, strong risk reward that you have for any moves to the upside, while just taking on a fairly small amount of risk to the downside. Because if TLT moved down to that 156 level, I would cut my losses again on, but the upside here, as you can see, remains fairly significant compared to that amount of risk that I'm taking to the downside. So fixed income markets providing a little bit of a risk on environment that we're seeing from HYG that supports this current broader market rally that we're seeing from US equities. US equities now remains the strongest asset class across the world, whether we're looking at emerging markets, globally, domestic, emerging markets. We're seeing US equities again remain the strongest asset class globally. And this is significant from the perspective of if we can continue that relative strength, that is also another net positive for US equities going forward, especially going into this Q4 earnings announcements and what is, we have the election coming up, and we also have the stimulus bill that everyone is kind of paying attention to, because that is also another big potential plus for this equity market rally. Now, when we look at earnings, this is really where, the early reports, JPM gave us a little bit of a glimpse into what earnings is going to look like. So far, JPM's earnings announcement was particularly strong. 4% growth in terms of revenue. Earnings beat the analyst expectations by a fair amount, and the amount of capital they're putting aside for their loan losses was substantially lower, speaking again to more confidence in the shape of the recovery and the confidence in just how much they need to write off in terms of loan losses due to the coronavirus. And they've put aside, again, close to $10 billion already, and they have only added another 600 million or so to that. So substantially smaller increase in that speaks to the confidence that they have in terms of what they think that their clients are going to experience going forward. So we actually saw, JP Morgan still remain fairly muted from this, despite the fact that they had a fairly strong earnings report. And that perhaps tells us something also, but the JPM has actually underperformed the XLF sector, certainly no longer what I would consider best of breed within this particular class of stocks. But if we look at Goldman Sachs, if we look at Morgan Stanley responding fairly strongly to this news here on JPM. So both of those report later this week. So those are ones that you could potentially see some bigger moves, as they are trading above the 200-day moving average on those particular stocks, while JPM is still fairly underperforming its sector here. So JPM giving us a bit of a preview as to what we might see here for this earnings period. We're going to be doing an earnings webinar this Thursday. So for those of you that join us Thursday afternoons, we're going to talk about the upcoming earnings season. We'll take a look at what our expectations are, what sectors we're paying attention to, and provide some examples as to how you can trade earnings plays using options and do so in a way with limited risk. So join us here this Thursday for that session. Now, in order for us to better understand the market outlook, we need to take a look at the fact that there was such a big difference in performance yesterday between the NASDAQ 100 and the Dow Jones. Dow was up 0.8%, NASDAQ was up over 3%. And what that speaks to is the fact that NASDAQ is concentrated in a few big names, and what we saw was mostly the outperformance of those big names. So we have to look at the FANG names to give us a better understanding. Now, when we look at the FANG names, there is a fairly wide spectrum in terms of how they're currently performing, depending on what their business model is. When we look at Amazon, which is a consumer discretionary name, this is where we see a lot of strength. Amazon also happens to have Prime Day today and tomorrow. This is a very important indicator for investors to better understand how consumers are going to spend this particular holiday season. Right now, expectations are all over the place. A lot of firms that were providing consensus as to what holiday shopping's stats were going to look like have actually pulled some of that guidance because just of lack of clarity. And the fact that Amazon pushed their Prime Day from July to October is significant because a lot of retailers have said that they actually want to prevent Black Friday crowds in their stores due to COVID. So these stores are now trying to figure out different ways to still capture that consumer spending towards the end of November, but do so in a way without crowding their stores. So they've turned to more online strategies. Amazon's certainly going to be a good preview or a good indicator of what type of strength we might see during this holiday season. So a lot of investors, I think, were a little bit optimistic about this, bid up Amazon as a result of it. Amazon, one of the big gainers here yesterday. So this is one that I'll pay attention to because Amazon has invalidated this head and shoulders formation. It has broken out above that right shoulder. It is now within spitting distance of that all-time high. And this is an example of a stock, in my opinion, that is likely going to resume that bullish trend here. Amazon largely has been, I would say, sideways and consolidating for the past couple of months here, and is now starting to break out higher and resume its move higher here. And you can project that move higher here. As you can see, that move from about 2,000 to 2,900. So you can project out this roughly 3,400 up another $900 or so to the upside. That's how we would use technical analysis to give us a broader picture as to the potential upside, longer term potential upside of a name like Amazon. And with the number of retailers closing, the number of bankruptcies that we're seeing from the retail space, that is just going to continue to push consumer spending towards these few dominant online players such as Amazon, Walmart. These types of plays are going to likely continue their outperformance here. Consumer discretionary, one of the few sectors also breaking out to new all-time highs here and testing those all-time highs, just like technologies. So we expect these two sectors to be fairly strong and continue to be strong out of the FANG names. When we look at Apple, this is another company that has a major event here today. They're releasing the iPhone 12. This is huge from an Apple's perspective in terms of not just the iPhone being a fairly critical component of their revenue, but the fact that they are continuing to move to create a single ecosystem across all their devices, iPhone, iPad, and desktop, or rather your Mac computers. So historically, Apple, iPhone, and iPad have been on the same ecosystem on iOS. You can run roughly the same apps across the two that use the same chips, but the Macs computers were running on Intel chips on a completely different ecosystem and in architecture. You couldn't run Mac apps, if you will, on your computer. Apple is moving towards a unified ecosystem across all three devices. iPhone 12 is also a big part of augmented reality, a big part of Apple's strategy going forward in terms of their next big innovation to change the way we work, change the way we interact with the world. So the iPhone 12 is a big piece of that, and having 5G included in that is going to be a big part. So a lot of investors very bullish here on Apple for the long run. If you look at the chart, similar type play here where you originally had a head and shoulders formation that has now been invalidated and moved to the upside. This is very similar to Amazon. So both I would argue that both Apple and Amazon are both in the consumer discretionary space in terms of hardware and spending, or people are buying physical devices. This is really what where we see a lot of strength here within the FANG names are in these two names. And when we look at some of the other names like Facebook, this is where some of the strength is just not there. If you look at Facebook, now, granted, Facebook, very different business model. Almost all of their revenue comes from advertisements. So when we look at Facebook, this speaks to more of investors, I would say, a sentiment on where they think advertisers or how much advertisers are going to spend going into the end of this year. And if we look at Facebook here, still within this head and shoulders formation, it has not broken out above it and invalidated that head and shoulders formation. So that doesn't mean that it's not going to break out. I actually believe that it's probably a good chance that Facebook will break out here to the upside. So watch this 280 level. Breakouts here to 280 will bring it back into the 300 level. But it just speaks to the fact that investors are just not as bullish on names like Facebook as they are for Amazon and Apple that have actual physical sales, versus Facebook only has advertisement sales. There's also some of the concerns about anti-monopoly trust suits that are coming through the DOJ and what that means for some of the names like Facebook and Google. So this is also, again, I think some of the things that are concerning for investors and putting a little bit of a lid here on rallies here for Facebook versus Apple and Amazon. When we look at Netflix currently putting in this triple top here at 150. This is one that could potentially break out here. Also, as you can see, momentum continue to move lower here, meaning having some upside here. Accumulation distribution also confirming a continuation of accumulation of this particular stock, which is generally speaking a strong suit, a strong indicator of potential breakout here. So Netflix looking fairly strong, even though it has predominantly been more of a range-bound stock. If we do get a breakout here, I would expect to see a fairly significant move into the 600s here for Netflix. So Netflix on the verge of a breakout, similar to Facebook, but Netflix perhaps a little stronger here than Facebook. The other one I want to take a look at here is also taking a look at being a little bit more defensive, because at the end of the day, we are still, in this recovery phase of a coronavirus, of the COVID-19. Coronavirus cases is still by no means under control necessarily. We still have a rising uptick in terms of cases every single day. So names like Clorox that have been predominantly, I would say, sidelined and just kind of grinding lower, started to become a little bit more interesting, I think, for some investors. Now, I don't necessarily know that Clorox is necessarily going to have the same leap that we had back in March, and that's not my expectation here, but I certainly think that what this has done is it's stemmed this downside move. It's put in this inverted head and shoulders. It is likely going to be more of a slow grind higher here, and I think suitable for selling premium, selling puts, selling put credit spreads. Those are the types of those are the types of plays that I would use, because you have a fair amount of upside here, all the way into the 235, 240s, and you would cut your losses below about 205 or so. So you're taking on a fairly smaller amount of risk for a fairly large amount of upside. So again, this is really where more of a fundamental and technical thesis line up to potentially find an options opportunity using put credit spreads or selling puts on a name like Clorox. When we look at Microsoft out of the FANG names, this is really, again, where we see one of these names that have put in a large head and shoulders formation, invalidate that head and shoulders formation, similar to the Qs in the S&P 500, and is now starting to move higher here. So if you look at the FANG names, you see a pretty wide spectrum: Apple, Amazon, Microsoft, invalidating those head and shoulders, speaking to me that these are stronger businesses, that investors have belief that they are going to likely provide some more outperformance, rather than names like Facebook and Google, which we'll look at here next, or Alphabet rather. When we look at Alphabet, very similar to Facebook, still have that valid head and shoulders formation, has not broken above that. Now, like I said, just because it hasn't broken above just yet doesn't mean that it won't. It just speaks to the fact that Facebook and Google, clearly investors have a slightly less bullish tone here to Facebook and Google as they do to the other FANG names. So if you're playing for further upside on some of these technology names, know where there is outperformance and where there isn't so much, and focus your attention on those names that do have that outperformance: Apple, Amazon, Netflix versus Facebook and Google, which again has been a little bit weaker from a relative perspective, and still having some of these resistance levels to deal with before they can continue moving higher. So with that, that covers what I wanted to share with you here today. I want to thank everyone for taking the time out here this morning. And I want to thank our members for supporting us, allowing us to continue doing this. I really enjoyed doing that members only special last Friday on the election. For those of you that were able to make that, again, we're doing the same type of webinar this Friday morning on technical analysis. Like I said, a lot of investors use technical analysis, but a lot of questions around which indicators should I use, which one's better than the other. I get that question a lot. So we wanted to put that question to bed by telling you exactly, based on a back test, which ones have the best performance, and a few other things that are really surprising that you may want to know if you're using technical analysis in your trading. And the common question: which moving average should I use? Should I use a simple or a exponential moving average? We tested all of these things so that you can understand where to which ones to use. So if you don't already have a membership and you want to join us here this Friday, just sign up using the link on your screen, which I just posted into the chat window. And if you don't have an OptionsPlay account, you can sign up for a free 30-day trial at optionsplay.com. With that, I want to thank everyone for taking the time out here this morning. I hope that this was helpful in giving you a better understanding as to where we currently sit in the broader markets, where we see some opportunities specifically within the technology space, and also just make sure that you're aware in the back, just some of the warning signs we are starting to see with this fairly strong move here in technology. Which names in the tech names to focus on, which ones not to focus on, or perhaps not as bullish on, and also taking a look at a different view. Look at earnings with the banks. Look at some of the staples with Clorox as the number of cases continue to rise. There are opportunities in places outside of tech as well. So we'll send out this recording to everyone as soon as we're done, finish processing it. So thank you so much. Have a great Tuesday, and I'll see you guys Thursday afternoon on our earnings education webinar. Have a great day.